Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. Marcus had been watching NVIDIA for 6 months. He had read the articles, he had watched the YouTube videos, he had seen the stock go from $80 to $90, then to $110, then to $130. Every week it went higher. Every week he told himself he would wait for a pullback. Every week the pullback never came. Then one morning, he woke up and saw NVIDIA at $142. The news was everywhere. CNBC had it as the lead story. His investing group chat had 47 unread messages. Everyone was talking about how this was just the beginning. Marcus bought. 3 weeks later, NVIDIA was at $112. He had lost nearly 22% in less than a month. He did not buy bad news. He did not buy a broken company. He did not make an obvious mistake. He bought at exactly the wrong moment, and he could not explain why. Here is why it happened, and here is the one signal that would have stopped it. This is not a story about Marcus being reckless. Marcus did everything a reasonable person would do. He researched the company. He believed in the business. He waited for confirmation before he acted. The problem is that confirmation is the trap. When a stock is in the news, when everyone in your group chat is talking about it, when CNBC has it as the lead story, that is not a signal to buy. That is a signal that the move is almost over. Here is what the data shows. Retail investors accounted for $5.4 trillion in trading activity in 2025. That is a 47% increase from the previous year. And research from Barclays published in January 2026 confirms something that experienced investors have known for decades. Retail portfolios show a clear bias toward stocks with momentum attributes. Retail investors are price trend sensitive. They buy what is already moving. That sounds logical, but it creates a predictable pattern. Retail money arrives late. It arrives when the story is loud. It arrives when the risk is highest and the upside is smallest. And institutional money knows exactly when retail arrives. JP Morgan reported that retail activity reached 36% of total order flow on a single day in April 2025, an all-time high. And research confirms what happens when retail surges into a position. Institutional investors strategically adjust, often counteracting retail-driven sentiment dynamics. Read that sentence again. Institutional investors counteract retail flows. When retail buys, institutions often sell. Marcus was not unlucky. Marcus was on schedule. So why does this keep happening? Why do intelligent people consistently buy at the exact moment they should be waiting? There are 3 reasons, and once you see them, you cannot unsee them. Reason 1. Pain of missing out is stronger than fear of losing. When NVIDIA goes from $80 to $142, something happens in your brain that has nothing to do with analysis. Every day you did not own it feels like a loss. Not a missed opportunity, an actual loss. The psychology literature calls this FOMO, but that word does not capture how physically uncomfortable it is to watch a stock you researched go up 40, 50, 60% without you. So you buy, not because the analysis changed, because the pain of watching became unbearable. Reason 2. Social proof replaces independent thinking. When 47 people in your group chat are all saying the same thing, your brain registers that as evidence. 47 people cannot all be wrong, but they can. And in markets, 47 retail investors saying the same thing at the same time is almost never a contrarian signal. It is a confirmation that the crowd has already arrived. The research from Barclays is clear. Retail investors lean on momentum strategies and on social validation. The louder the conversation, the later the entry. Reason 3. News coverage peaks at the top. This one is counterintuitive. Most people assume that more news coverage means more opportunity. The opposite is true. News coverage of a stock is a lagging indicator. Journalists write about what already happened. CNBC covers NVIDIA at $142 because the move from $80 to $142 is the story. The story is the top. By the time a stock becomes a mainstream news item, the investors who made the real money are already looking for the exit. So what is the one signal that stops this? It is not a complicated formula. It is not a proprietary screener. It is a single question that Marcus did not ask before he bought. Who is selling what I am buying? When retail buying surges, institutional selling often follows. Not always, but often enough that the question is worth asking every single time before you commit capital. Here is how you ask it in practice. Look at the volume pattern over the last 10 trading days. If volume was higher on down days than up days in the week before a breakout, that is institutional distribution. Big money was selling into strength while retail was buying the story. Look at the price action on the day of the breakout. If the stock opens strong and fades into the close, that is not a strong breakout. That is a stock where supply is overwhelming demand at the top of the range. Someone with size is using your enthusiasm to exit their position. Look at the news cycle. If the story is on every major outlet outlet on the same day, ask yourself who benefits from maximum retail attention at this exact moment. These are not guaranteed answers. Nothing in markets is guaranteed, but they are the right questions, and most retail investors never ask them. Marcus went back and looked at the Nvidia chart after his loss. The volume pattern was clear. In the 5 trading days before he bought, 3 of the down days had significantly higher volume than the up days. The stock was moving higher on lighter volume and pulling back on heavier volume. Institutions were distributing. Retail was absorbing. The news cycle peaked on the exact day he bought. 42 separate articles about Nvidia published on that one day. The following week, the coverage dropped by more than half. The price action on his entry day showed a strong open that faded into the close. Nvidia opened at $144 and closed at $141. The bulls could not hold the gains. The sellers were larger than the buyers by the close. Every signal was there. Marcus just did not know what to look for. Here is the framework distilled into 3 checks. Run these before every entry. Check 1. Volume tells the truth. More volume on down days than up days in the 2 weeks before your entry means institutional distribution is happening. Wait or reduce your position size. Check 2. Price action on breakout day. A strong close near the high of the day is a real breakout. A fade into the close is a warning. Strength attracts buyers. Fading attracts sellers. Check 3. News cycle timing. If the story is everywhere on your entry day, you are buying the headline, not the business. The best entries happen when the story is quiet and the chart is already moving. None of this will make you perfect. Markets will still surprise you. The framework will still have false signals, but the investors who consistently avoid buying at the top are not smarter than Marcus. They are not luckier. They are simply running a check that most retail investors never learn to run. The question is not whether Nvidia was a good business. It was. The question is whether $142 was the right price to enter on that particular day, with that particular volume pattern and that particular news cycle. The answer was no, and the chart told him so. He just did not know how to read it. Retail investors are more sensitive to headlines and tend to deploy capital during periods of volatility, often buying when institutions are de-risking. That single sentence from the research describes exactly what Marcus did, and it describes what millions of retail investors do every single earnings season, every market rally, every time a stock becomes the story everyone is talking about. The fix is not to stop buying stocks. The fix is to stop buying stories. Run the 3 checks. Look at the volume. Watch the close. Check the news cycle timing. When all 3 are clean, the entry is real. When 1 or more flashes a warning, wait. The stock will still be there next week, and you will be buying from a position of information rather than emotion. Amateurs buy the headline. Investors buy the setup. Visit ProfitByFriday.com today. Subscribe free to the Friday Flash, where you will receive 1 stock fully evaluated through the Clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.